Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for June 24th, 2018. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.05 fell from 1.38 last week, continuing within bullish territory. The total count of securities in bullish or bearish patterns was virtually unchanged at 2,942. The count of bearish stocks increased 16%, while the count of stocks in bullish patterns decreased 12%. The Pirls P&F market breadth summary chart shows us a market now 7 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 33 points for the third decline in 11 weeks. At a positive 516.05 points, it continues above the April and December 2016, January 2018, February 2017, May 2016, July 2017, and March 2018 tops, and continues below the remaining two tops above plus 100 in the last 30 months, as well as continuing above all four bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode, with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 4 accumulation days and 5 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week also, the Nasdaq ended in distribution mode on higher average daily volume. Momentum. The CCI 20 daily at a positive 51.99 is down from a positive 101.03 last week. We continue to wait for the CCI 20 daily to return within the plus or minus 50 range for another zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 112 weeks ago, while the daily CCI 20 began a Woody's uptrend 9 weeks ago. The CCI 20 weekly fell to a positive 139.11 from a positive 164.50 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: retail and REITs on top, oil, brokers, and some tech on the bottom. Bullish, S&P retail continues in the top 5. REITs has left the bottom 5 and entered the top 5. Oil continues in the bottom 5. Bearish, computer hardware and semis have entered the bottom 5. Brokers has re-entered the bottom 5. Oil services has left the bottom 5. Disk drives has left the top 5. Focus this week. from www.zerohedge.com. BIS confirms banks use layman-style trick to disguise debt, engage in window dressing. The following are some key points and a chart. We showed how banks were purposefully making their balance sheets appear better than they really are with the aid of short-term Fed facilities for quarter-end regulatory purposes, a trick that gained prominence first nearly a decade ago with the infamous Lehman Repo 105. And this is a snapshot of what the reverse repo usage looked like back in late 2014. Today, in its latest annual economic report, some 4 years after our original allegations, the Bank for International Settlements has confirmed that banks may indeed be disguising their borrowings in a way similar to that used by Lehman Brothers, as debt ratios fall within limits imposed by regulators just 4 times a year, thanks to the use of repo arrangements. For those unfamiliar, the BIS explains that window dressing refers to the practice of adjusting balance sheets around regular reporting dates, such as year or quarter ends, and notes that, quote, window dressing can reflect attempts to optimize a firm's profit and loss for taxation purposes, end quotes. But why repo? Because as a form of collateralized borrowing, repos allow banks to obtain short-term funding against some of their assets, a balance sheet expanding operation. The cash received can then be on lent via reverse repos, and the corresponding collateral may be used for further borrowing. At quarter ends, banks can reverse the increase in their balance sheet by closing part of their reverse repo contracts and using the cash thus obtained to repay repos. This compression raises their reported leverage ratio, massaging their assets lower and boosting leverage ratios, allowing banks to report them as being in line with regulatory requirements. In other words, to help banks appear healthier than they are for regulatory purposes, central banks are essentially diluting the impact of their own monetary policy. This is hardly a new development, and as we explained in 2014, one particular bank was notorious for its use of similar sleight of hand. As Bloomberg writes, the use of repo borrowing is similar to a, quote, Lehman-style trick, end quote, in which the doomed bank uses repos to disguise its borrowings, quote, before it imploded in 2008 in the biggest ever U.S. bankruptcy, end quote. The collapse prompted regulators to close an accounting loophole the firm had wiggled through to mask its debts and to introduce a leverage ratio globally. How ironic, then, that it is central banks' own financial operations with bank counterparties that make a mockery of any macroprudential regulation attempts by central banks and effectively exacerbate the problems in the financial system by implicitly allowing banks to continue masking the true extent of their debt. Makes me want to go watch The Big Short again. Thank you for watching this week's Santu Pirls Stock Market Commentary video featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. For Santu Pirls Stock Market Commentary, I'm Cindy Pearl, hoping that you have been enjoying a peaceful and pleasant weekend. that you're looking forward to a prosperous and productive week coming up, and wishing you true success.